All right. So why don't we get stuck into it again? Thank you all very much for joining us tonight. Just to quit a bit of upkeep. You should be able to see a little box somewhere on your screen. I've got a little box here. Um, I don't know if yours looks the same as mine. I'm always presenting. I'm never a guest, so I don't know what your screen looks like. You might be able to type in your question and answers there. If you've got any comments or you've got any questions, please type them in. I'll address them kind of mainly at the end, but I'll try to keep an eye on them as I present. Sometimes I can get a little bit stuck into what I'm saying, right? I'm the only one talking tonight. It's just me. Uh, when you're the only one talking, you start to go on a roll, if you know what I mean, a bit of a tangent. You tend to riff a bit. You can go down rabbit holes, and so I can get really involved in what I'm saying, and like I said, I might forget about the questions, but I will answer any at the end. If you've got any technical issues, give us a call at the office. The number should be on your screen. There should be someone mulling about who will be able to help you jump on. But otherwise, again, thank you so much for taking an hour of your night tonight to listen to what I have to say. I don't suspect I'll go longer than an hour. If I do, forgive me, but it's hard to judge. You know, I don't have a script or anything. I'm talking about the things in the slide share. I'm very passionate about it. And again, for clients who know me, I can go on tangents, right? But I'll try to, you know, stick to the track tonight. All right, stick on track tonight. So you might be wondering who we are if you're joining us for the first time tonight. We're Traders Circle and we're Emerald Equities. Two different businesses, albeit very similar. Traders Circle has been around since 2005. We're a small business. There's 12 of us in the office. We've been around for a very long time. We've all been here for a very long time as well. I've been with the business for about 10 years, but I'll introduce myself in a moment. Traders Circle is more focused on the shorter term to medium term styles of trading. So essentially, we're traders that want to support other traders. We provide some education. I'm not going to really go into the education tonight. I will a little bit at the end. But ultimately, if you are looking to learn to trade, or you want to learn how to trade options, which are a type of derivative, then I think we provide the best education and support in Australia. I wholeheartedly believe that. Plenty of evidence to suggest that as well, I think. And once we've taught you how to trade, we support you and help you practice. And the idea is that we assist you in your live trading as well. So we're full service brokers. I'll go through a little bit more at the end there. So just to kind of give you an idea as to how you can get involved. Emerald Equities, on the other hand, is more like a sister company. Emerald Equities is more focused on medium to longer term investing, perhaps is a better word, rather than trading. Investing for me is more about capital growth. So we provide some of the best stock screeners in Australia. We've got a really good scoring system that gives you an understanding as to how a stock is performing and what our projection is of it in the future. And we take a lot of different things into account and give you a score. We've got a lot of fundamental information. We've got great stock recommendations. Our stock recommendations have gone really well since its inception. Of course, past returns don't equal future returns, but I encourage you to go and check that out regardless. So with both sides of the businesses, or with Trader Circle and Emerald Equities, we like to think that we can cover the shorter term styles of trading where, you know, people look to generate an income stream, and we can cover the longer term where people are looking for more capital growth. My name's Caro Cornips. Again, I think a lot of you will know who I am, but some of you may have not heard of me before. I've been with the business for about 10 years now, I would say. I used to say 8 years a lot, but I think I've been saying 8 years for 2 years. So by my maths, I've been with the business for about 10 years now. I am an advisor and I'm the head trainer as well. So part of my job is to educate people on the stock market, specifically to derivatives and options trading. I have a strong passion for the market, and technical analysis I really quite enjoy for shorter term styles of trading. So if you ever want to discuss anything like that, you're welcome to drop me a line. I've had people who, you know, are in a bit of a sticky spot when it comes to derivatives or don't really quite understand options, give me a call, and I'm very happy to spend the time with you to explain what exactly is going on and help you solve some problems. But otherwise, you know, my job is as an advisor. So I give people advice on their trades. I give them trade ideas, help them price up strategies, help execute orders. So, you know, it's very normal for someone to call me up and ask me to, price up a strategy on a particular stock that they have a view on, for me to give them my view on that particular stock, and then to execute that order as well. So I like to think I'm a full service broker who can provide a lot of value to your trading and a lot of sound advice as well. Now, just before I get really stuck into the guts of it, just keep in mind that any advice contained tonight is general only, so it's not tailored to your personal circumstances, and you need to decide for yourself as to whether it's appropriate to you. So tonight's webcast is about the basics, really. And I've run these types of webcasts before, so if you've attended them in the past, then this will be familiar to you, and it'll help solidify that information. But I'm going to run through a couple of recommendations that we've given our clients, in the last 3 or 4 weeks. One that's finished, or maybe a couple that's finished, and 1 or 2 that's open at the moment as well, so that you can track it. So that'll be a point of difference there. The next webcast, which is next Wednesday, I think that's the 10th, that'll be during the day when the market's open. And what we're going to do is we're going to take things that we've talked about tonight, some of the core concepts, the basics of what it takes to become a successful trader, and then we're going to try and apply that to the live market. Okay, and I say try because the market is a fickle beast, right? And like my technology tonight, which I had a couple of issues with, this is why I'm starting a bit late. The market can be a bit fickle as well. In fact, it can sometimes, it can remain irrational for longer than you can remain solvent, is an old saying, right? It's a bit of a cynical saying, but it's a saying nonetheless. We'll try next Wednesday to apply what we've learned, hopefully to some great success. So be sure to join us for that. Now, the foundations of a successful trader, I believe, can be boiled down to 3 main areas, and they're in front of you on your screen. In order to be successful, you need to be able to pick direction, right? That's a very simple way of saying you need to be able to speculate on the future direction of a stock, right? That's essentially what trading is. You need to be able to choose the right strategy that allow you to profit from that view, and also that allow you to manage your risk, which is the third component, risk management. You're not going to get every trade right. I mean, ultimately, if you had 100% strike rate, you actually wouldn't need risk management. But we don't live in la la land. We live in reality. You will have losses. In fact, you'll have a string of losses at some point, and you'll have devastating losses at some point. That's what you need to expect as a trader, because you're a human being that needs to learn and gain experience. And part of that is taking losses, right? It's a cost of doing business in some sense. And so you need to have a good risk management plan in order to manage that effectively, right? So these are the 3 main pillars, I like to call them, of being a successful trader. And what brings them all together is a set of trading rules. So, if you left right now, or your eyes glazed over, and you didn't listen to anything else I had to say, that'd be okay. This is probably the most important slide of my presentation, and I like to deliver it early whilst you're still fresh, right? Before you've fallen asleep or before you've switched off. It's a long day. I get it. It's it's the end of the day. It's 7 o'clock at night on a Thursday, right? You just battled most of the week. This is the most important slide. You need to be able to be good at picking direction. You need to have appropriate strategies under your belt. You need to be able to manage your risk, and you need to bring it together in a set of trading rules. Okay, easier said than done, of course, and this is really what the rest of the presentation is about. Now, when it comes to picking direction, which is what we're going to talk about first, obviously, there's a lot of stuff going on at the moment, right? Well, there's a lot of stuff going on all the time, but it feels like more so now than ever before. Would you agree with that? I think the world's changing I think we're witnessing history right now, more so than ever before. Something changed in the early 2000s, and I think we're starting to see really the full bloom of that at the moment. It's hard to put my finger on exactly what that is, and maybe you'll pause for a moment and maybe you'll think about that. Maybe it'll something you'll think about later or discuss later. But I think it seems right now there's a lot going on. I think that's fair to say, and I think we're in a new era in some ways. Just perhaps like when we went through an industrial revolution. Right now, we're going through a technological one. And my generation have certainly taken the reins in a very different, led the horse down a very different path to what the previous generation has done. For good or for bad, I don't know, right? And that's not really the point I'm trying to make. But essentially, there's a lot of things that you could listen to. There's a lot of news articles that you could read. There's a lot of books that you could read that are new and that are old, right? There's a lot of political stuff going on. It feels like the world is divided, but I don't know. I'm what I'm. How old am I? I'm 30, about 30 years old, right? I've listened to things from the Reagan era and afterwards that people felt very much the same way. So I don't know if it's just normal for people to feel that there's a lot of division in politics at the moment. I'm not sure. Perhaps that's the way it's always been. But certainly there seems to be a lot of different forces pushing and pulling the market, right? Some of them are logical, some of them are illogical. Certainly there's a disconnection between the market and the economy. So how do you make sense of it all? And that can be very tough, right? And tonight I'm hoping to some degree help alleviate that and to make sense of it in some, I guess, to give you a path forward, right? Something to study. I'm not going to give you the tools to go out there and trade straight away and make lots of money. That's obviously, I wouldn't never promise that. And you should be wary of any company that does. But I am hopefully going to give you a path forward, something that you should go out and study, right? Whether it be through my company or another. What you need to be able to do is you need to be able to take all that information, all that noise, and you need to be able to funnel it into a step-by-step process. And that can be very difficult, right? It's taken our company a very long time for us to be able to funnel that into a way that's effective for people to begin to learn, right? It's not effective for everyone. There's no one size fits all approach to the market. There's no silver bullet. There can't be, because otherwise there would be no market. If everyone bought at the same time and sold at the same time, it would make no sense. It would be, the market couldn't exist. The market could only ever exist because of differing opinion, because there's more than one way to skin a cat, and because there's different time frames to trade, right? We actually rely on that. So we've developed a process that we think is appropriate for beginners to learn. We give you a good foundation, a set of rules to trade with. I'll touch on this a little bit at the end there. But if you don't have one, this is something that you need to try and develop yourself. A set of trading rules is very important, I would say, for very obvious reasons, but why don't we touch on them? Trading rules keep you disciplined, right? Discipline is always a good thing, isn't it? It inherently has a positive connotation. Being disciplined is important because trading can be very emotional. You have an emotional attachment to your money. Funnily enough, I think it's my generation that have this kind of ironic attachment to money that actually makes us kind of okay traders. But as you get older, you actually get more scared of things. I felt this myself, right? Become more, I don't know, conscious of the reality, and so emotion can really start to play in when it comes to your finances. And that automatically means that your trading is emotional. What a set of trading rules helps you do is it keeps you disciplined and reduce that stress a little bit. It helps simplify decisions. So rather than having this kind of analysis paralysis, which can really set in, especially as a beginner, mind you. And look, I shouldn't just say as a beginner, even as an advanced student. A trading rules helps simplify that decision. It helps take out some of the guesswork, and ultimately helps you make decisions. Now, your set of trading rules is never going to be perfect. You shouldn't expect it to. That would be folly, really, in some ways. What your trading rules need to be, though, is tested, right? And they need to be logical, obviously, as logical as they can be in an environment which is fairly subjective. Would you agree? I mean, it is, right? It's a fairly subjective approach that we're trying to take, right? Because there can't be an objective one. So in the realm of subjectiveness, you want to have as much of a logical and tested approach as you can. And so a company like us that gives you kind of an approach which we think is logical and tested, you can take that, you can apply it, you can see, and then you can evolve it to your personal circumstances as time goes on and as you get experience. right? Now, beginning with technical analysis, um, we're not going to focus on fundamentals tonight, right? Fundamentals are great for longer term investing, but technicals, I would say, should be the focus tonight because they're better for shorter term styles of trading. Okay. That's not to suggest that you shouldn't do both, but you want to lean heavily on one of them as opposed to the other, I feel, right? So it's not just about going, okay, well, I'm not going to bother with fundamentals. I'm just going to look at the technicals, or vice versa, depending on what your time frame is. It's about just going, okay, well, I'm being very aware of what's going on with the other, but I'm going to be mainly leaning on one. So I'll go into that a little bit more in a moment. But just to kind of give you a rounded idea as to what the differences are, right, in case you didn't know, fundamental analysis is a lot more focused on like company balance sheets. What you're doing is you're looking at the profitability of the company, the sector it operates in, its market share, how much it's growing, the dividend it pays out. You're looking at the very raw fundamental data of the company, and you're seeing, okay, well, what's that company worth? What's it going to be worth in the future? Right? And how does that reflect in their share price? And is there an opportunity there? Is it oversold or is it overbought? Or, you know, eh, essentially that type of information, right? You can look at ratios. It can get very mathematical very quickly, right? It's a bit of a, it's like the nerds approach, right? uh, you know, you wouldn't want to be mathematically literate to go look at fundamental analysis, right? But again, fundamental analysis is perhaps better for the longer term position of the stock, right? And what your analysis is, because we find that fundamental analysis plays over a longer period of time, right? It actually doesn't really affect the shorter term machinations of the market. It can in some ways, right? So, for example, a company report, can be very volatile in the short term for the market. So that can directly affect the share price, right? Uh, that's a piece of fundamental analysis. But broadly speaking, the fundamentals of the company play out over the long term. Technical analysis, on the other hand, is actually kind of simpler. It's just about understanding what a chart does, right? So the best way of saying it is it's about understanding past price data so that you can predict future price movement, right? So what does past price data mean? Well, you could look at a spreadsheet with all the past prices that the stock has traded at, but that would probably be insane. Instead, you graph it, right? And that's what a chart is, right? A chart is just essentially all the past prices that the stock has traded at. And we look at that and we analyze that to hope to predict future price movement. And it can sound a bit wishy-washy, and in fairness, it kind of is, right? It's a little bit of art, it's a little bit of science. I don't really want to get stuck into that. It's the idea that because a lot of people believe it, it kind of works. It's a self-fulfilling prophecy. And rather than getting into the mechanics of why it works, let's just understand that it does. Um, and ultimately, that's what we think works best in the short term, right? We find that the stock listens to levels rather than fundamentals in the short term most of the time. And so as traders, we like to focus on it. So we're going to run through that a little bit tonight. Then we're going to run through a little bit of strategy, and then we're going to run through a little. Look, we'll touch on risk management. Risk is a little bit personalized. Okay, we go through it in the course that we teach beginners, but I don't really want to get stuck into it tonight. Tonight's more about trading. Okay, the other two major components I feel, which is strategy, and more importantly, technical analysis. So the foundations of technical analysis can be, in my opinion, it's boiled down to lines, so trend lines, counter trend lines, support and resistance lines. Then it's about using those lines to identify technical patterns, right? Then what we look for is entry and exit signals, and that can also be covered in patterns as well. And then confirmed with mathematical or technical indicators is what they're probably known as, properly known as, sorry. Okay. Technical analysis is kind of like painting a picture. I wrote an article on about this many years ago, and it's an analogy that I continue to use because I think it's fairly apt. And that is to say that when you paint a picture, what you're doing is you're applying several different artistic principles in order to bring forth a message or a picture or something like that, right? It depends how kind of deep you wanted to get into it. But by the very least, you apply line, you apply in shape, you apply shade and color and hue and all those types of things, right? In order to paint a picture. And technical analysis is very much the same way. You can't apply one of these principles and hope to understand what the stock is doing or to help predict what it's going to do, more importantly. It's actually only until you've applied all these concepts does the picture become clearer, and then you might have the confidence in order to place a trade. That's the goal, isn't it? Right? A lot of this game is confidence, right? You might think that you've picked direction, but what you need more importantly is the confidence to actually trade that view. And so what we're really doing with technical analysis is gaining confidence to trade our view. Some people don't need a lot of evidence to have the confidence to trade their view. Those people are bigger risk takers. And that's fine. That's, you know, that's who am I to say, right? And some of us are perhaps a little bit more conservative. And those definitions can be very loose in itself, right? What does conservative mean? What does risky mean, right? Something to think about. But regardless, why don't we get stuck into this? So what you're looking at there is a chart, right? And it's got a whole lot of mess on it. That's probably the best way to describe it. It's just mess. But this is just a chart I took. You know, that's our market today, right? That's what that's the XJO. That's the ASX 200. That's the index of our market. It's made up of the top 200 stocks weighted by market capitalization. But you know, it looks super crazy, right? So by the end of the night, I'm hoping for you to understand roughly what's going on here, okay? So that you could look at this chart and just have a rough idea as to, you know, what it all means, okay? So the first thing that we want to do is and by the way, sorry, this is a chart of the ASX. I think it's about a month or two old, all right? I'm reusing a little bit of old data because I think it's, you know, it's a really good example, and you know, I didn't really feel the need to change it. But just so you're aware, this is not the XJO. This is the chart of the ASX stock. So one thing you guys might not be aware of is the ASX, the Australian Securities Exchange, the ASX, our stock market, is also a private company that trades on itself. I don't know of any other index that does this, by the way, even overseas. I think it's a complete conflict of interest. Don't even get me started on it. But that's, and I didn't. This is not meant to be a loaded thing. I just like this. I just like this chart when I found it at the time. I was trading it, and I thought it was a really good chart. But yeah, just so you know, this is the chart of the ASX. This is not the ASX 200. This is not our market. It's the private company that trades on itself, right? Just to kind of screw with your head a little bit. So the first thing we want to try and do when we apply our technical analysis is something that I would say is fairly simple, but is, you know, it's easy to learn, but I guess harder to master. And that is to identify what the trend is and what the trading range is, and to draw in your trend lines. So you can see quite obvious that the stock is trading in an uptrend over this period of time. Now, if I was looking at the trend from a longer period of time, maybe it wouldn't be up, maybe it'd be down, maybe it'd be also up. I don't know, right? That's not really the point. The point right now is in this period of time, the time frame that we're trading, the trend is up. Agreed? And this is defined by higher peaks and higher troughs, right? You know what a peak and a trough is, right? A peak and a trough, right? Higher peaks and higher troughs. The trend line is the gray line that you see on your screen that is underneath all the price data, right? And the trend line acts as essentially a support level. So each time the share price comes to the trend line, it bounces higher. So you're creating a bit of a rule in some ways, aren't you? You're essentially saying, okay, Each time the stock has returned to this line, it has not fallen further. Instead, it has eventually turned around and headed higher. And the great thing about that line is you can actually project it into the future. Now, will that line be proven to be correct all the time for the rest of history? Of course not. Will the trend always be up? Nope, of course not. But the idea is that you make kind of enough money for as long as that is right, so that when you are wrong, you can minimize your losses and you still end up ahead, right? And if that was a bit quick for you, don't worry about it. We'll cover it a bit later. But the first step is to draw your trend line to identify your market range and your trend as well. The other thing that you want to draw in your resistance levels. Now, typically you would draw a resistance as a horizontal line, not one with a gradient like I've drawn here. But I think this is fairly obvious that there is a defined market range. So that when I look at the stock, I can go, okay, well, when the stock has reached this resistance level, historically, it has turned around. And that's happened on several accounts. It's happened at least, if I was to use my mouse just to highlight to you, it's happened at least once, twice, maybe 3 or 4, 5 times. And so the 6th time it gets there, there's a chance that it also turns around, right? And what that does is it gives me a target, right? I go, okay, well, if the stock gets to that line, I probably want to be out of the position. And I just need to check, can I make enough money in order to warrant a trade here if it gets to that position? Now that I've now that I've identified the trend and the market range, the next thing that I want to do is I want to figure out where the next key support and resistance is. Okay. So in this particular chart, there's a key support where I've drawn that line. Now, what's interesting about that line is that in the past, it was a resistance level, and it was actually what you call an ascending triangle. But again, I'll run through that in a moment. This line here, when the stock reached it, it bounced down. When it reached it again, it bounced down. It was only on the 3rd attempt did it actually break through. Now that it's broken through, that resistance level turns into a support. And so what's interesting is that what defines a resistance or a support is purely where the share price is in relation to it. If the share price is above that level, it's a support level because it may support the stock from falling further. If that line is above the share price, then it's automatically a resistance level because it may resist against the stock moving higher. So really, they're just inflection points is probably the best word to use. But what we're really talking about here is language. We're just talking about jargon, right? It's the word that we use to identify something. Right now, that's a support level, but in the past, it was a resistance level. Does that make sense? I hope it does. Now that we've identified the key support, which was a key resistance, the next thing that we want to identify are any patterns that we see, right? And any subsequent breakouts. So once you've drawn your key resistance, your key support, you've drawn in your trend lines, your market range, your counter trends, once you've drawn in your lines, right? And you can have, by the way, you could add more lines to this chart if you wanted to, but I am trying to keep it simple. Is that fair enough? Once you've drawn all your lines in, what'll happen is you'll start to see uh, technical patterns, right? And if you're using candlesticks or this OHLC type chart, you could also try to identify candlestick patterns, right? Which again, you can also see in OHLC charts. In this circumstance, as I said to you earlier, what we've got is an ascending triangle, and that's when a resistance level meets an uptrend line. And it's called a triangle pattern, right? Because these lines aren't parallel, are they? Eventually they will meet, and the stock will be forced to either break that resistance level or it will be forced to break that uptrend line. Now, obviously we've broken the resistance level, and it's kind of like a spring sometimes, right? Where the stock gets squeezed to the point of the triangle, but as soon as it breaks, it usually, especially if it has good volume, it usually continues in that direction. And so triangle patterns are typically continuation patterns. So the stock is kind of consolidating, it's going higher, it's going higher, it's going higher, but then it realizes it doesn't really want to go beyond that level for a while, and it's consolidating. It's thinking to itself, do I have the strength to push through? Am I really worth it? Like, yeah, like the bulls and bears are kind of arguing at the moment. They're having a meeting. They're going, does this stock deserve to be really trading much higher? Yeah, we'll test it a few times. And then eventually it breaks, right? And usually it breaks in the direction of the underlying trend, like we've seen here. So you get this rally up. It doesn't want to push higher. It doesn't want to push higher. And then it does this time round, the third time. Funnily enough, I find that it typically is the third or fourth time that it actually does break through. If the stock's failed 3 times at resistance and it does go to test it the 4th time, I reckon most of the time it does push through the 4th time. I haven't actually got data to support that argument. It's anecdotal evidence only, but I feel that that's the case. I've noticed that usually it's the 4th time that it gets through. But don't get me wrong, sometimes it takes sometimes it never breaks through. Sometimes it ends up being a reversal pattern. But I don't really want to get stuck into that. The point is that more often than not, it is a continuation pattern. And what you are looking for is the break here, right? The break higher does give you confidence in trading that bullish trade, because now you've got confidence that trend is continuing. Oops, sorry. There's the break there. Now, the fourth thing that you want to do is look for entry signals. So you might have a general idea as to what the stock's doing, right? It's trading in an uptrend, it's holding this resistance, etc. But that doesn't give you necessarily a great idea as to when to enter your position. Like, do I enter it now, or do I enter it like in an hour's time? Should I have entered yesterday, or should I enter tomorrow? I mean, the timing can be important, and that's what your entry. Well, timing is important because that's what your entry signals are about, right? I don't know about you guys, but there's been a bunch of trades where I was like eventually right, but I'd completely just mistimed it by maybe a week, 2 weeks, a month. It sometimes sounds fairly obvious because you could say that a broken clock is right twice a day, and that can be sometimes how you feel. But sometimes you just mistime it by a week, and you go, that's frustrating. You know what I mean? So timing is very important, and entry signals can help identify the right time. And this is also where those candlestick patterns kind of come in. Evening star, morning star, that type of stuff. I don't want to get stuck into that. That's starting to get into things that I think are a little bit more advanced that I don't really, again, tonight's about the basics. But right now, these are the things that I think you should be focusing on. So far, we've covered trends, counter trends, support and resistance levels. We've covered patterns. Now we're covering entry signals. The final thing that you want to do is you want to confirm with indicators. Indicators are the last thing you look at, not the first. So indicators are essentially mathematical algorithms, as far as I can tell, that are quite often represented as a graph. So you can see below here, I've got something called the stochastics, right? The stochastics are essentially moving averages overlaid to give us a bit of an idea as to what the stock is doing. It's a lagging indicator. And there's a few ways that we use them. As a beginner, what you use them for is the overbought, oversold region. So what you might look at is, see these dotted lines here? Anything above that dotted line there is what you consider overbought. And anything below the dotted line is what you would consider perhaps oversold, okay? And again, it's what you call a lagging indicator, but it can still help you predict the future, right? But it's a confirmation tool only. Sometimes it can be as simple as just looking if they're pointing up and if they're spreading apart. If they're pointing up and spreading apart, you're looking for bullish momentum. But the other thing that we look at them for, which is I think the more advanced way of looking at them, which I don't want to get into tonight, is what you call divergence. And you guys are going to watch a whole bunch of YouTube videos on this, right? Anything I cover tonight, there's like a lot of YouTube videos that cover this. The difference between YouTube videos and what I do is that I support you, I explain, I answer your questions, and I hold your hand as you practice and learn, right? Going it by yourself can be very difficult. I suggest that you guys either get a really proper education and or you get a mentor. Don't skip out on one of those things, right? If you go read a book, that's fine. If you go watch YouTube videos, that's fine. Just make sure you have a mentor like me or someone else to be able to answer your questions and guide you. Alternatively, make sure that you, if you don't want to do that, then go and pay for a good education like what we do or someone else does, and then go and do it yourself, right? Don't skip out on one of the, both of those things, right? Ideally have both, obviously. But yes, sorry, I digress. The stochastics are just a confirmation tool, right? And ultimately, um, confirmation tools need to be done at the end of your analysis, right? A rookie mistake is to lead with them because they kind of they're almost like a um, they're like a cheat sheet in some ways. Um, you know, I'm trying to describe what I'm saying. They essentially they give people an easy way of doing something, and so people lean on them a little bit too much as beginners. And so what they do is they look at the stochastics first, or these are the other indicators I've got here. I've got the 50-day moving average, which is the green line, the 100-day moving average, which is the blue line, and the 200-day moving average, which is the red line. I quite like moving averages, but to kind of solidify my point here is that people will look at the moving averages, people will look at the stochastics, the MACD, the RSI, the Bollinger Bands. These are all indicators that you guys might be aware of or currently using. And that's the first thing that they look at. It really shouldn't be because it actually influences your decision making when you do the rest of your analysis. And remember at the start, I said technical analysis is kind of like painting a picture. It's not just about doing one thing. You can't just put lines on a page, right, or a canvas. To stick to the analogy, you need to do all the other artistic principles to have confidence that what you're painting is actually the thing that you're trying to portray, right? Or in this case, what the stock is telling you to do, right? So if you lead with technical indicators first, you'll you'll be biased, I feel, right? So put them at the end of your analysis if that's not what you're already doing. The last thing you look at is your stochastics. The last thing you look at is your MACD, RSI, Bollinger Bands, etc. Now, in this case of the moving averages, they can be used a lot of different ways. I really like them. Some people don't use them. That's totally fine. You need to find what works for you. We actually don't teach moving averages to beginners either. It's something that we will cover later on. And again, it's up to you as to whether or not you use them. I find them very useful. Some people don't. What I like about the moving average is that very simply, something that a beginner can understand is that they essentially are a support level. The 50-day is really cool for that, right? I find that very good for short term. You can see the stock moved above it in this circumstance, but it used as support here. It came down, bounced off, came down and bounced off, came down and bounced off. You can even argue it bounced there as well. Came down and bounced off, came down and bounced off, came down and bounced off. It used it as a very, very, very keen level of support for the market in the short term. And it does it for a lot of stocks. So I really like the 50-day, but I also like the 100 and 200-day. And again, I don't really want to get stuck into it, but they're a great technical indicator I find very useful. But again, I only look at them at the end of my analysis, right? After I've applied all my lines. I know I'm laboring the point, but forgive me. So let's summarize, shall we? The first thing we want to do is we want to identify the trend and the trading range. And the way I did that, I drew the uptrend and I drew the another uptrend on top of the stock to show a what you call an ascending channel, right? The second thing that we want to do is we want to apply our key resistance and support, right? Or inflection level, if you want to call it that, just our key levels. The third thing is we want to combine all those together to identify any patterns. The pattern that we identified was the main one that we identified was the ascending triangle, which is a type of continuation pattern. But the other pattern that's in play is the ascending channel, right? The fourth thing that we looked at was entry signals. So now that we understand kind of the narrative of the stock, right? Oh, it's a upwards trading stock. It's trading an ascending channel. right? It didn't really want to get past this point, but now it's broken through. We want to identify that entry signal, right, to give us an idea as to when to enter the trade. I mean, it's fairly obvious, right? The final thing that we did was confirm with our technical indicators, and we did that with the moving averages and the stochastics. But you could, again, there might be other ones that you'd like to use. I like to use the Bollinger Bands as well, but I know other people who like to use the RSIs, the MACDs, and other moving averages as well. Because I've got the 50, 100, and 200. Some people like to use the 7 and the 9, I think. Yeah, there's a whole bunch of technical indicators out there that people like to use. The only other thing that I didn't really cover was your fundamentals. So I mentioned earlier that fundamentals are something that you still want to consider, right? And look, put it this way, if you're investing, if you were like buying stock and just holding on to them, which some of our clients do, right? Not every one of our client is a full-blown trader. You might still want to look at technicals in order to time your entry, right? There might be stocks that you like going, this is a really good stock fundamentally. Yes, very good. When do I buy it? Do I buy it now? Do I just like throw caution to the wind and just buy it now? Sure, why not? I mean, in 10 years' time, if it's a good stock, it's not really going to matter, is it? But, you might want to time it a little bit better. And I say that's more important now than it ever has been, because the old saying was it's not about timing the market, it's about time in the market. But I don't believe that's as true as it used to be. And I said this at the start of the webcast, and I'll repeat it now. Things are different now than they were 20 years ago, or even 10, or even 5. The world's changing, and I don't think it's reasonable to suggest that the old lessons are as relevant as they are now, or they're not as relevant anymore, is probably the right way of saying it, sorry. So I think that you do want to time a little bit your investments, right? And technical analysis can help you do that. On the other side of the coin is that if you're shorter term trading, you're leaning on your technicals, but it's still important to consider your fundamentals, right? You need to know when a report's coming along. Like, for example, NAB is trading next week. Westpac was earlier this week, and ANZ was last week. It would probably be not a great idea doing a trade on those stocks unless you knew that was coming. Don't be ignorant. You know what I mean? You want to be aware that these things are occurring, because they can certainly shift price. The other thing is that if you're looking at a trend and the stock is looking overbought, you might want to look at the fundamentals to see if it deserves to be here. Right? You might be like, oh, well, this company is rubbish. I don't know why the stock is rallying so much. Must be momentum. I'm going to stay away from it. Or you might look at the stock and go, oh yeah, hang on a second. No, it is a really good stock. I can understand why it's trading at these kind of levels. That makes a lot of sense. Yeah. Right. You do want to consider your fundamentals. As a beginner, though, I will say this, and again, I know I'm kind of getting off track a little bit here, but as a beginner, I can understand why you might want to stay away from the fundamentals in the beginning. Okay. You might feel like it's a little bit too much, and that's totally fair. Alternatively, you might come from a fundamental background, right? And technicals is new to you, whatever, Trevor, right? The next step is to plan the trade, right? So now that you have your view, the idea is to trade it. What's the point otherwise, right? Now, planning your trade is what I call the strategy section. And as a trader, you want to have different strategies. Buy low and sell high is super basic. It's super archaic. It's really limiting. It's also going to affect the way that you view the market, because if the only strategy you've got is buy low, sell high, that's the lens that you interpret the market through. Actually, a good saying is that if the only tool you have is a hammer, then everything else looks like a nail. You know what I mean? All right. So there's a few ways that you can trade your view. You can buy the stock. That's fair enough. If it's bullish, you could short the stock, but if you can short stock, well, you probably already know what you're doing. You're not attending my session anyway, because that's really only available to really sophisticated traders and people with lots and lots of money, or institutions. Shorting stock is also, as a trader, like as a retailer, like people who are listening, like you guys, me, I don't see any logical reasons to why you would short a stock when you could just trade options or minis. And that's what I want to talk to you about tonight, just a little bit. I'm going to give you a few examples. I'm running out of time, actually. You guys will forgive me if I go over time, right? Sometimes we go past 8. I go past the hour. Sometimes I've been on for an hour and a half. If you have to jump up, I'll understand. Just watch the recording. So obviously, you want to have a set of trading rules that really dictates, how you implement your strategy, especially when you're doing more complicated strategies, right? Buy low, sell high doesn't need as much of a vigorous rule as, say, trading a mini warrant or an option does, right? The more complicated the position, the more boundaries you kind of need in order to make sure that you're staying safe and also you're doing what's logical and sensible, right? If that doesn't really make sense to you, I'll explain it in a moment. So we like to trade derivatives, right? If you haven't heard that word before, that's fine. A derivative, as the name suggests, derives its value from the underlying stock. And if that doesn't make sense, essentially what it means is that as the stock moves, right, as the share price moves, so does the value of its derivative. So you can trade derivatives on stock like CBA, you can trade them on BHP, you can trade them on Wesfarmers, Woolworths, Coles, AMP, AGL, LLC. There's a lot of stocks that you can trade derivatives on, right? Technically, I'm pretty sure you can trade derivatives on the top 200. And there's different types of derivatives, and that's what I'm going to go through a little bit tonight, a little bit. The reason why we like to trade them over simply buying and selling stock is because they offer advantages that stock don't. One is the ability to trade any market condition. So what's awesome about derivatives is we can trade bullish strategies, we can trade bearish strategies, and in some circumstances, we can trade sideward strategies. And that's really cool, right? Because if you think about it, if you're trying to trade, right, and when I use that word, I'm suggesting that we're buying and selling fairly regularly in order to generate an income stream, then you want to be able to trade different market conditions because essentially you're just increasing the amount of trades that you could do, right? The market doesn't just always go up. It goes our market loves to go sideways, right? But it can also go down. And being able to capitalize on that is important, in my opinion. What it also allows you to do is it allows you to read the market from perhaps a less biased perspective because you don't care if it's going down. You don't care if it's going sideways. Perhaps your investment portfolio does, but your trading portfolio doesn't because you can trade it. Does that make sense? The other good thing about derivatives is leverage, right? If you don't know what leverage is, essentially, it essentially means that you can use less money to make more money. And that sounds really crude, and I don't like that explanation, but that is essentially as basic as I can get it, right? Compared to stock, I'm just comparing that to buying and selling stock. The problem is that if you want to be able to make more money, then you also have to risk more money, and that means you can lose more money. And so leverage is really only for someone who understands what they're doing, right? And I say that because let's think about this for a moment. People need to understand. I don't think people understand risk properly anymore. Maybe they used to, but it feels like it feels people need to really understand risk. What does that actually mean? Well, okay, you can get from A to B by walking, right? Let's use this analogy. I like to use this analogy, see if you like it. You can walk from A to B. Let's say you need to get from where you are to where you need to be. One way you could do that is walk. That's something that you learned at a very young age, theoretically, and most of us can do it, hopefully. And I would say carries very little risk, right? You're kind of your own person. The chances of you getting hurt are very minimal. You'd have to walk through some pretty bad neighborhoods, right? But there's still a risk, right? To leave your home and go somewhere carries an intrinsic risk. It's called living. You could trip, you could get, something could happen, right? I'm not trying to be cynical, but it's possible, right? But it's a small amount of risk. The other way that you could get there is you could drive, right? You could get into your car and you could go 100 kilometers an hour, knowing full well that if you crash, there's a very real chance of severe injury or even death. Again, I'm sorry to get grim, but it's a really good analogy. To get from A to B, you could walk it. It's going to take a very long time, but it's a lot safer than driving, right? Driving, on the other hand, will get you to where you want to be a lot quicker. It's almost like a mechanical marvel that you own such a piece of complex hardware, right? And you can go at speeds that not only would endanger your life, but also the people around you. And for some reason, we've got these traffic lights, we've got other cars on the road, we've got lanes, little white lines that for some reason make us feel safe in that environment, right? But if you really boil it down to it, you are doing something that's quite insane, right? Kind of, right? But the point that I'm trying to make is that you're taking a higher risk. Intrinsically, you're taking a higher risk so that you can get to where you want to be quicker. And that's all that derivatives allow you to do. They allow you to take a higher risk so that you can generate an income stream so that you can make more money. And that's not for everyone. It isn't, right? There's a reason why we license people to drive and you have to wait till you're like 16 or something in order to just even step in a car and put your hands on the wheel, right? There's a reason why you have to take a test. There's a reason why you have to get someone mentoring you first. And I don't think derivatives should be any different. They're a leveraged product, which means you can use less money in order to make more money. There's a lot of flexibility that comes with them, which makes them inherently more complex, right? If you've got more flexibility, there has to be more complexity, but they're awesome, just like cars, right? I mean, I think that's a great analogy, but tell me if you agree. But that's essentially how I liken it. Now, should you just go and get in the car and put the pedal to the metal? Probably not, because you might hurt yourself. In fact, you'll probably hurt yourself. But maybe if you get educated, maybe if you have someone there to guide you and hold your hand and mentor you, maybe if you were to pass a few tests, practice first in a parking lot before getting on the highway, right? Maybe if you do all these things first, maybe it can be really beneficial to you, perhaps, right? Maybe not, but it's something that's worth considering in our opinion. You can see what I'm saying about going down rabbit holes, right? Um, the types of derivatives that we like to trade are called mini warrants, right? And options. Now, mini warrants allow you to trade bullish strategies as well as bearish ones. So if you wanted to do a bullish trade, you could enter a mini warrant, just like buying in stock if you wanted to. But if you wanted to do a bearish trade, so you thought the stock was going down, you could also enter a mini warrant and you could profit from that as well. You wouldn't have to short the stock, right? Again, I don't know why anyone online, including myself or anyone that I know, would ever short a stock when they can simply buy a mini short. You can argue that one with me, I don't care. Mini warrants have capped risk. That's very important to us, and it should be important to you as well. You should never enter a strategy that has infinite risk. People do it all the time. Australia is cracking down on them. You can do them through options, right? But the only strategies that we ever teach to people with options have capped risk as well. But mini warrants, you can't do unlimited risk. They're always capped risk, which is great. They also have inbuilt stops, which can kind of protect you against yourself. So if you enter a position and the position goes against you enough, eventually you'll just be forced out of the trade, which, again, can be good for a beginner. Could be a bit of a detriment if you're a bit more of a seasoned trader, but I don't want to get stuck into that. The idea is that you're protected in a lot of ways with mini warrants. They're highly liquid, so you don't ever have to worry about getting filled or anything like that. That's totally fine. You could trade them on about 200 different stocks. You can trade them on some currencies, including the Australian dollar versus the US dollar, the Australian dollar versus the euro. These are things that we've suggested to our clients in the past in terms of recommendations. You can trade them on some base commodities like gold and silver, for example. We've suggested given trade recommendations on gold and silver in the past. And you can trade them on some overseas futures like the S&P 500 or the NASDAQ, for example. What's awesome about mini warrants is that you can trade them on stock, currencies, commodities, and indices all through our market. You don't have to open up a foreign exchange account. You don't have to open up a US trading account and worry about foreign exchange fees or anything like that. You can just trade them through our exchange, which is really awesome. And the other thing that's good about trading them through our exchange, unlike CFDs, for example, which is, I would say, similar, is that you're protected by Australian regulation, right? And there's a lot of transparency. With CFDs, you could trade those through an overseas company and have no protection. I don't want to really get stuck into that, but I think mini warrants, I think everyone should trade mini warrants. I trade them all the time. They're like my number one thing. I think they're fantastic. The other type of thing that we like to trade and we like to teach clients are options. Now, options are the most flexible thing that you could possibly trade in our market because they provide a high degree of strategy as well as leverage. So with mini warrants, you have a handful of leverage that you could possibly do, right? It's not a great deal of choice, but with with options, you just have, you could just like you can do almost anything with options. They're fantastic. Right? Now, what I mean by different strategies is that you can implement strategies that profit from multiple directions. So not only can you do a strategy that profits from bullish or bearish positions, but you can also implement a strategy which makes money if it goes sideways, right? It's a popular strategy that we like to implement in our market because our market loves to track sideways for periods of time. Now, you might think, you might ask the question, what type of time frame are we talking? With options, you can do positions that that are intraday, right? If you're a day trader, you could do positions that last for a couple of days to a couple of weeks to a couple of months. And it's more the latter that I was talking about. So we would typically implement positions that last, I would say, anywhere from a few days to maybe a month or two when it comes to options, maybe, right? That's the type of time frame I'm talking. The type of strategy that you can implement earlier, as I suggested, was not only bullish, bearish, and sideways, but you can also do combinations of. So you can enter a position that makes money if the stock goes sideways or up, or you could enter a position that makes money if the stock goes sideways or down, right? You can even enter a position which makes money if the stock goes up or down. And that's a really cool strategy to implement when you're looking at reporting. You can see I've written that in brackets there. So, for example, NAB is reporting next week, right? Now, I haven't done my research yet, but what I would do is I would go look and see historically how much does NAB move on its report, and if it moves 4, 5, 6, 7%, something like this, let's say over the past 5 years, then I would consider entering a position where I make money on a big move up or a big move down. What I lose money on is sideways movement if NAB does nothing. But you would tend to find that things do move on the report. Some things don't move a lot, but some things can move a lot, right? And provided the stock goes up a lot or down a lot, you profit. And that's a really, really good strategy to use during reporting. And it's something that we teach to our clients. It's something that we recommend to do around the reporting season. Now, when it comes to risk management, before I get stuck into risk management, I said I'd show you a couple of trades that we've got going. So why don't we do that? See, I told you, I get ahead of myself. Let's cover any questions. Previous slide, I'm not sure what that means. Yeah, so that's a great question. If you trade a derivative, can you get the dividend? And the answer is, well, yes, in some circumstances and no in others. So for example, if you trade the option, the dividend price is inbuilt into the option. So you're kind of trading it already, if that makes sense, because there's no free lunches in this market, right? You can't, like when a stock goes ex-dividend, we know it falls by the ex-dividend amount, right? So for example, if Fortescue's paying a 10-cent dividend, Fortescue's share price must fall by 10 cents on ex-dividend date. It must. It must. And people know that. I know that. You know that. Everyone knows that. So you can't really take advantage of that. You can't do a bearish strategy and make money off that 10-cent fall. That would be free money. And the market doesn't hand out free money. This is the thing, ladies and gentlemen. If you think there's a clever way of making money, someone else has thought of it. There's no free lunches. All right. There's a lot of people who look for that silver bullet and it doesn't exist. I promise you right now, because computers have already thought of it or taken advantage of it. Right. So the dividend is already factored into options. Mini warrants, on the other hand, there's two types of warrants that you could trade. There's mini warrants, right, where it's already factored in, or you could do something called perhaps an installment warrant. and you actually get the dividend. So for example, I will do one of the, I find myself trading mini warrants more often, but every now and then, if I know the dividend is really good, like Fortescue, I'll buy an installment warrant on and get the dividend. And that's what I did with Fortescue. I bought the installment warrant, and I got paid the dividend in cash. And that, like, what is the right answer is really tough to answer, but it's totally up to you which one you want to do. We don't teach installment warrants to beginners. We just want to keep things simple for beginners. So we just cover mini warrants. And so no, you won't get the dividend, but you can trade derivatives like installment warrants where you do get the dividend. It's a really long-winded answer for you, right? I hope that makes sense. But that's not where I wanted to go right now. What I wanted to do was kind of show you, this is my chart, a few of the recommendations that we've done. So, all right, so this is a, so what happens is, if you come along and do education with us, right, or if you're a client of ours who's paying for membership, one thing that we do is we give you trade recommendations, or suggestions might be another word that you could use. There's a couple of reasons why we do that. One, a lot of our clients are small business owners, they're full-time professionals. And so they don't have as much time as I or my colleagues have, or perhaps other people do, to go through the market and look for trades. So what we do is if we see a trade that we like, we'll write some analysis for you. And that's what you can see on your screen right now. So can you see that box there? And I'll scroll down in a moment so that you can see the other information. But we essentially write all that information, put together the analysis and say, hey, this is a trade that we've seen today that we'd like. Feel free to do it if you want to. Sometimes those trades will be a desk trade, which has rules. Like each of us advisors have slightly different rules. Like the rules that I stick to might be a little bit different to my colleagues, right? Because we all have our differing opinions. That's totally legit, totally fair. And then there's other inner circle recommendations, which only stick to the trading rules that we teach you. So the rules that you learn, if you come along through our education, if we find a trade that sticks to them, then we'll tell you about it. Now, obviously we miss some, right? Because sometimes we won't see it and you'll see a trade that we don't see, right? And there's obviously gray in those rules, right? And up for interpretation, because again, there's no such thing as objectivity. Well, a lot of the time there's no such thing as objectivity, which means a lot of the time there's subjectivity. And that means that subjectiveness, that's probably is the right word. And that means you're going to see trades that we don't see and vice versa. But if we see any trades that fit the rules, we'll tell you about them. So here is an example of using a mini warrant in order to profit from our view. So this is a CTD trade that we did not too long ago. That was the 15th of October. And you can see all the other information that you could possibly want to know. That's the code of the mini warrant. And you could go to your platform, and if the market was live, you could type that into your depth screen, and you could bring up the value of CTD KOA, which is the mini warrant. Okay. We suggested a technical stop. So we identified, if I just jump to the chart of CTD, actually, you know what? It's in this screen. I jumped to the chart of CTD. This actually looks kind of similar to the slide. So that's why I chose this as an example to show you tonight. You can see there's the market range, right? There's the uptrend line, there's the resistance line, there's the support level, and there should have been a resistance level drawn in there, but that doesn't matter. We wanted to use $22, which is roughly here. Sorry, down there as a technical stop. Hopefully you can kind of see the chart clearly on your screen. We suggested a minimum amount of contracts. You can obviously do as much risk as you want. And we suggested a price, which was $8.40 with 15 cents discretion, right? So $8.40 times 375 is 3,288.75, roughly speaking. So this was the analysis. We wrote some words for it. We said, this is why we like the trade. This is what we're suggesting to do, etc. We gave you a chart, and then we also gave you a payoff matrix. And we said, okay, well, if the share price gets to roughly $25.40, we'll make about 22%. You see that there? That's 22%. So that was the current share price when we entered the trade. If it goes up that much, we make about 22%. So a 2, 4, 6, 8% rise, an 8% rise in share price equals a 22% profit in this trade. And that is the definition of leverage. The share price rose 8% and we could make 22% profit. That's leverage. You guys understand what I'm saying? The problem is that if the share price falls 8%, we also make 22% loss. Right? I need to drill that home a little bit here because leverage sounds awesome on the upside, but you need to respect the fact that it can smack you on the downside as well. And that's why you need to know what you're doing. You need to have risk management. You need to have all these kind of pieces of the puzzle together, right? So, by the way, I'm aware it's 10 past 8. I'll try not to labor too much. We provide all this information to our clients. We did the trade. We suggested a close not too long ago, and we actually ended up getting filled today for a nice profit. I think we made that 22%. So 22% on your original principal is whatever you want. If you risked $1,000, you'd make $200, right? Times 0.22, that's $220 you would have made, right? If you had risked 5,000, you would have made about $1,000, right? So just an idea of what that means. I thought I'd give you a couple of other trade ideas that we've entered. You could keep track of them yourself if you wanted to. A lot of these people, funnily enough, I prepared for this yesterday. Funnily enough, people closed this REA mini long today. So this is what REA looked like. We define the market range. You can see it's channeling. That's in the Cybers channel. We've got the downtrend line or the counter trend line breaking at the moment. The stochastics are coming out of the oversold area and pointing up. It's a nice little bullish entry signal there. Plenty of room to the upside, so we suggested a mini long. The target was around 171. If it gets to around 171, you make about 30% profit. And I think clients closed out for something like that today. So it ended up getting close to that resistance level today. I'll show you what I mean. If I could just go here. I don't think it was 30%. I think it was, we didn't actually quite get there. So some. Now you can choose when you close this trade. We don't care really. I mean, we care, but you know what I mean? It's up to you as an individual. We don't mind is probably a nicer way of saying it. It's up to you when you take your profits, when you take your losses. We just provide suggestions, right? Remember, we only provide general advice. So a lot of people closed today for I think it was like 20% profit, which is still pretty good, right? It was 20%, right? I think that's a good profit. So that's what the chart looks like. We went from down here to up there and we made our money. The final trade that I want to show you today is a options trade. And I don't want to focus on options today because we only teach options to advanced students. Options are complicated, right? Because they're the most flexible thing you can trade. Remember I was saying that before? If there's a lot of flexibility, it makes sense that there's a lot of complexity. And do we really want to teach complex things to beginners? No, probably not. What we'd rather do is we'd rather teach you how to pick direction. We'd rather give you a set of trading rules. And we'd rather teach you how to trade mini warrants because they're simpler. It's only once you've kind of learned that stuff do we then go, hey, if you want, you can come learn about options. It's up to you. We don't, like, it's up to you. It's not integral to you making money. But we really like them because they provide a lot of flexibility and they're really good for trading, we find. So this is what we call a bull call spread. Traders give very funny names to things. We have bull call, bull put, and they're very self-explanatory. But then you come across things like iron condors and butterflies because why not, right? So this is a bullish strategy that utilizes call options, right? A bullish strategy that utilizes call options. So it's called a bull call spread. Again, as I said, very self-explanatory. If you don't know what a call option is, that's fine. this webcast is not on options trading. We have run some in the past, and you can find them on our YouTube page. So I encourage you to go check that out. But this is a bull call that we did on SHL. Again, we provide all the analysis. I actually write the words for all of these, for the desk trades at least. And this is the chart. So you can see a nice uptrend line in play. The counter trend line representing the triangle pennant pattern, the breakout. I've got the moving averages there. You can see it's holding or just moved above the 100-day, which is good. It might need to contend with the 50 or that resistance level, but ultimately we do believe it's going to head back somewhere near that $43, $44 mark, right? The stochastics are pointing up. There's good volume on the buy. We don't need much more of a reason to implement a bullish strategy on this, right? So we decided to do a bull call spread. What's awesome about the bull call spread is, as you can see, it actually profits from time decay. So what that means is that the current, this is, if you have a look, this is the current share price at $40.64 when we entered the trade. That's 1% higher, 2% higher, 3% higher, 4% higher, 5% higher, and 1% lower, 2% lower, 3% lower, etc. That was the day that we entered, the 27th of October. That was 5 days later. That was, that was 6 days later, 6 days later than that, etc. You can see I've got the time increment there on 6 days, and I've got the price increment on 2%. So it's essentially a payoff matrix. That's what we call it, a payoff matrix. So if the share price remained exactly where it was, in 6 days' time, you'd make $30. Yeah, it's nothing to write home about. In 12 days' time, you'd make $50. And in 18 days' time, you'd make $80. And in 24 days' time, you'd make $130. And in 30 days' time, you'd make $190. In 36 days' time, you'd make $290. And in 42 days' time, you would make $470. Now, I don't know. I think I counted in sixes okay there. I might have been completely off. It's very late at night, so forgive me. But the idea is that if the share price doesn't move, as time progresses, the amount of money you make actually accelerates, right? Because time decay is not linear. We don't make the same amount of money in the same amount of time passing. The more time passes, the more money we make accelerates. That's important to understand. Can you see that? If the share price goes up, we can take a profit as well. But if the share price falls, we cop it. So this is a strategy where we not only make money if the share price rises, we also make money if the share price goes nowhere, which is pretty cool. And that's good for a stock like SHL, because SHL, like a lot of stock and the market, likes to go sideways. And so I checked this trade today, and we're up about $360, right? I think we're up about 9%, 10%. So we've made 10% with the share price only rising maybe 1 or 2%. And the reason why we've done that is, one, because of leverage, but two, because we also make money from time decay. We've been in this trade for a couple of weeks already, and that's helped us, right? It's covered our costs at least, and that's pretty cool, isn't it? So anyway, that's what options allow us to do. You can keep track of this trade if you want. You can see the share prices here. You can see what time decay does. You can keep track of the trade. You can call me and go, hey, Kara, you talked about that SHL trade in your webcast. How's that going? Have you made money or have you lost money? We're very open, right? I don't shy away from it. And you can do the same thing for REA. But again, I think that's a bit unfair. A lot of people closed REA today. So I think there's some people who are still in it. Anyway, that's strategy. So strategy is very important. You need to be able to trade your view. You need to be able to profit from what you're speculating, right? And so we like to trade mini warrants. We like to trade options because they provide flexibility in a sense that they allow you to trade different market conditions, which is very important for several reasons. And they allow you to trade with leverage, which again, we think is awesome, because if you want to make $2,000 or $1,000, right, you want to generate an income stream. Options means, and mini warrants means, you don't need to have exceedingly large amounts of capital in order to do so. But it also means that you need to know what you're doing, and you need to get educated first, and you need to practice first. And that really comes down to risk, doesn't it? And that's the final piece of the puzzle that I mentioned earlier tonight. So risk is very important because you're not going to get every trade right. You're not going to get every trade right. So the idea is that you mitigate the damage. You try to make sure that the losers don't outweigh the profits of the winners. You know what I mean? Now, I'm not going to spend a lot of time here. Um, yeah, I'm not going to spend a lot of time there. Forgive me, right? We might talk about it a bit more on the Wednesday session. So the only thing I really want to cover tonight is a few other peripheral things, right? So for example, why do people trade? Something to think about, right? It seems obvious. People, and this is what people say to me. I go, why are you interested in trading? And they go, I want to make money. Oh, okay. Well, that's fair enough. Um, but money is a mechanism at the end of the day. I mean, money isn't real in a lot of ways. Money is confidence. Money means that I can buy nice things. Like, for example, I'll be honest with you, I'm having a very nice gin at the moment as I deliver this presentation. Um, you know, I- Money buys us things that we like to have, but it affords us a lifestyle, is really what we mean. And that's something that's important to think about because as a trader, you might want to set yourself some goals. You might want to move to full-time trading. Perhaps you'll want to move to part-time trading, right? I think part-time trading is a good goal for people to have. Don't quit your job because that's a really good source of income that trading could fill eventually, but in the beginning, you don't want it to because it'll be too stressful. Trust me, a lot of people won't tell you this, but if you've got like, especially if you've got like a wife or you got kids, right? If you got other people relying on you, do you really want your next trade to have to pay the bills? Probably not, right? Not as a beginner. Later in life, maybe. If you're a retiree, you've got a lot more time because you haven't got a full-time job. You've got your super, you've got other forms of income, right? Life's not about having one income. It's about having a diversified income stream. And trading is just one of them. So I encourage everyone to kind of look at part-time trading. I think that's probably a good way to put it. What makes a good trader as well are certain qualities I found. So I've been with the business for about 10 years, but I've also read books. I've also watched other people's webcasts. I find that there's qualities that these people share. And it's good to identify them, isn't it? Consistency is number one. I put that there as numero uno for a reason, right? Because at the end of the day, every successful trader is consistent. If there's anything to be said about psychopaths, right? If you had to boil it down to people who are unemotional, is that at least they're consistent, right? They're not volatile people. They keep a very consistent emotion. They keep a very consistent approach. Discipline is part of that. Obviously, you need to be able to have the discipline to be consistent. You need to be independent. That's something that I don't think people think about a lot. I, I don't want to tell you how to trade or what to trade. The problem is that I can't make decisions for you because I don't know what your risk tolerance is, and I couldn't possibly know. Even if you told me, I couldn't feel that, right? So the only person who's a good trader for you is you. Now, investing is a little bit different. You could invest your money into some kind of fund, and that funds manager could make decisions based on that fund for a longer term perspective. That's a little bit different. But for trading, the best trader for you is you, not me. You obviously need to be driven to succeed because at the end of the day, trading is hard. Trading is a career choice in a lot of ways, right? It's like a secondary career. It's a lifetime pursuit, a vocation, if you will, right? It's something that I will do. I know in myself, I will do until I die, probably, whether that be tomorrow or whether that be until I'm old and gray. Right? It's something that I'll do for the rest of my life. I know that. It doesn't matter how, what happens. Well, I shouldn't say that, but you get my point. And so you need to be driven to succeed. I always say to people, if you're learning to trade, don't expect to make money in the first year. What your first and maybe even second year is about gaining experience. And sometimes you need to pay for that. the market might not be very good for trading either. And sometimes the market for a beginner can be not great. The last year actually was a great time to learn to trade, in my opinion. But in hindsight, that might not be true because you might get used to a good thing, etc. You might not know how to handle a bad market, all that type of stuff. But you got to start somewhere, right? Everyone has to start somewhere. But just understand the first year, you have to be willing to kind of lose money or even break even, and you're paying for that experience because trading is a life pursuit and you need to be able to be driven to succeed. And finally, you have to enjoy it, right? It can't be a job. I don't do this work because it pays my bills, albeit it does. I do this work because I enjoy it. When I was in school, I was driven towards economics and I was driven towards art, funnily enough. And I paint almost every day. So I wax and wane. Sometimes I paint a lot more and sometimes I paint a lot less. I really enjoy art and I really enjoy economics and I enjoy science, right? We're all multi-dimensional people. Um, and I found that this type of stock market stuff really kind of satisfied a lot of different areas of my personality, and I really enjoy it. It's not just a job for me, and I think trading needs to be the same for everyone. I don't think it can be a chore. I think it's something that it would be hard to be driven if you didn't enjoy it. So I thought I would include that because it's something that people skate over. I don't think life is about just being miserable all the time, right? Even if it means financially successful, right? I don't think being more wealthy makes you more happier. Certainly helps, but yeah, I think you need to enjoy your trading. Look, it's getting late in the night. I apologize that I'm kind of laboring things. The other thing that you want to have a think about after tonight and going into next Wednesday is that if you're interested in trading, how are you going to do it, right? Or how are you going to learn? So I think I've expressed fairly clearly tonight that we run education, but I think more importantly, I hope that you understand that you know, if you're going to learn to trade, then there's a couple of things that you want to have. You want to have a good education and you want to have a mentor, or at least one of those things. Don't skip out on both of them. So, a lot of people online, I would say there's a bunch of people who are probably at the first stage, which is not really knowing which path to go down and doing a lot of research. And that's a very important step because it can kind of dictate the type of trader you'll become. Because just like your parents, the person that you learn from or the books that you read will shape the type of trader that you'll become initially. Is that fair enough? The next thing that you want to do after learning is practice, right? You want to approach things fairly logically. You want to test things like a little scientist dude, as you can see in the middle there. And then finally, you obviously want to implement it in the live market. This is the approach that we take at Traders Circle, right? So I'm not going to run through our education courses tonight, but just to give you an idea, this is the kind of approach that we take. So you want to have an approach which is very structured and practical. There's no point, in my opinion, going and doing a university course. I've done them, right? And some of my colleagues, I mean, I'm not going to knock uni, but it's fairly theoretical. It's not going to help you make money as such. And that makes sense, right? If you think about all the knowledge that you know, only a small portion of it actually helps you make money. There's a lot of stuff in my brain that's fairly useless. It's a small amount of practical knowledge that actually helps me make money and be successful. And that's what we focus on. You want to cover the core skills and you want to be supported if you can, right? So you want to have a mentor, someone who's there to hold your hand, who's there to help you practice, who's there to answer your questions, run point. That's again obviously what we provide. Because if we think that you should have something that's going to help you be successful, that's obviously what we're going to try and provide. Now, again, what we decided to do is we decided to try and tackle all those three kind of core concepts. Again, that makes sense. If we can help you become a successful trader, then obviously you're going to remain a client. You're going to continue to use our services, and that's what keeps our doors open. Our education is not really a profit center for us. It's something that we kind of break even on. Our education is really a stepping stone to hopefully you becoming a successful trader and becoming a long-term client where we can continue to provide advice for you to trade through us. We collect membership and brokerage, and that's what pays my wage. So if you're interested in education, I implore you to have a chat to us. You can always speak to me directly if you want. You're best off speaking to my colleague Jared. who's our market advocate. He understands Trader Circle and Emerald Equities. He's the head of the education department. He'll be able to talk you through all that type of stuff. You're welcome to speak to him, but if you prefer, you can always speak to me as well. That doesn't bother me. If you're not interested in education, but you're interested in a broker that you can talk to. So if for example, if you wanted to be able to call me up and say, hey, Caro, I'm looking at BHP today, or I'm looking at a Invacare or something like this. It's like a nice, it's a nice bullish entry signal today. What do you think? Do you think it's a, what do you reckon? And I'll be able to give you that advice. You could say to me, what type of strategy do you think I should do? Or I'm looking at this strategy. Could you put it in the market for me? Or I'll go trade this, etc. If you want that type of support, you can always trade through us, right? Because we can provide you that expert advice in not only direction, but also strategy. We're gonna help you manage your risk. And like if you're out and about and you're not in front of a computer and you want some proper advice on the positions that you're in, you can always call up about that as well. Now, obviously for longer term trading, our level of service is probably not needed. But if you're trading short term, especially if you're trading options or mini warrants or other types of derivatives, our level of service can really, really help you. What really makes us different, I feel, the reason why our small business is able to navigate the complicated world and the really kind of like robust world of online trading, right? There's a lot of free platforms out there. There's ComSec. The reason why we're able to compete in this type of environment is because we focus on you as an individual, right? We want to support you as much as we can. And also we don't get individual broker commission. So I don't really care if you trade, right? I mean, I do on an emotional level, but my paycheck doesn't change. I get paid the same wage every fortnight, right? It doesn't, if you trade or you don't trade, doesn't affect my decision. I don't get paid on commission, which, a lot of brokers do. So if you're interested in trading through us, you're welcome to give me a call, or you could just open up a trading account, go to our website, lodge an inquiry there. Or if you want to come along some education, do the same thing. But otherwise, again, thank you guys so much for joining me tonight. Again, I'm sorry that I've gone over a little bit. I'm about an hour and a half, 50% over time, but it happens. I think we covered a lot of good ground tonight. We covered a lot of technical analysis, picking direction type of stuff, covered a few things about options and mini warrants, and then we touched a little bit on risk. If you've got any questions, type them in now. I show all the questions that come in, right? Again, I don't try to hide anything. Good luck, Alex. Alex, you're a client of ours, so yeah, I'll speak to you soon anyway. I'm sure that all of you will get the recording. I'll make sure that it does. And be sure to join us for next Wednesday, which is the 10th of November. We're going to be doing it at 12 or 1, I think 1 p.m., sorry. And we'll go through the market. We'll look for some trades and we'll apply everything that we've learned tonight in that session. So until then, I'll speak to some of you before then. But if not, good luck and happy trading.